If you own investment property in the Inland Empire, from Rancho Cucamonga and Upland to Riverside, San Bernardino, Ontario, and Moreno Valley, listen closely. 2026 is shaping up to be one of the most tax advantageous years real estate investors have seen in a long time, and not because of the hype or the headlines, but because of very specific tax changes in federal tax law that are now in effect. With the passage of the One Big Beautiful Bill Act of 2025, the federal government permanently restored some of the most powerful tax tools available to real estate investors, tools that directly impact cash flow, after-tax returns, and long-term wealth building. Now, while many people were focused on interest rates, election cycles, and short-term market noise, sophisticated investors here in the Inland Empire are quietly doing something else. They're aligning their acquisitions, renovations, and their exit strategies with the tax code as it exists right now. Today, I'm going to walk you through what these rules actually say, how they work in practice, and how the Inland Empire investors are using them to legally reduce taxable income and keep more of what they earn. So if you want clear, plain English summary of how these tax strategies could be applied to your own properties or investment goals, just DM me. Here's the reality for real estate investors. Taxes are not just something that you deal with in April or October. They affect every decision that you make. What you buy, how you finance, when you renovate, and when you sell. If you own property in cities like Chino, Claremont, Fontana, Riverside, San Bernardino, or Rancho Cucamonga, you're operating in one of Southern California's most durable long-term housing markets. Population growth, job centers, logistics, healthcare, and affordability relative to coastal markets are supporting ongoing demand. But here's the catch. Two investors can buy the same property in the same city at the same time and at the same price and end up with very different outcomes purely based on how they will understand and apply tax rules. Ignoring tax planning doesn't make it simpler. It simply just makes it more expensive. Now, what we're going to do today is strip away the confusion and focus on a handful of tax strategies that actually matter in 2026. Permanent 100% bonus depreciation, cost segregation, Section 179D, energy efficiency deductions, 1031 like-kind exchanges, and qualified opportunity zones. Not theories, not loopholes, but codified provisions of current law that investors can use if they understand the rules and work with the right professionals. In mid-2025, Congress passed H.R. 1, the One Big Beautiful Bill Act, and it made several meaningful changes to the tax code that directly affect real estate investors. The most important for our discussion today is this. 100% bonus depreciation was restored and made permanent for qualifying properties acquired and placed in service after January 19, 2025 under the current law. That distinction matters. This is not a temporary extension. This is not a phase-out schedule. Under current statute and professional tax commentary, 100% bonus depreciation is now permanent for qualifying property. In plain English, bonus depreciation allows you to deduct the full cost of certain qualifying assets in the year they are placed into service instead of depreciating them slowly over decades. Traditionally, residential rental property is depreciated over 27 and a half years. Commercial property over 39 years. Bonus depreciation doesn't change those base schedules, but it allows specific components of the property to be depreciated immediately if they meet the criteria. And that brings us to what actually qualifies. Now, under longstanding IRS guidance, bonus depreciation generally applies to property with a class life of 20 years or less. Now, in real estate, that often includes flooring, cabinetry, and interior finishes, appliances and fixtures, certain electrical and plumbing components, HVAC systems, and mechanical equipment, qualified land improvements such as parking lots and sidewalks, as well as curbs and landscaping as well. These are not creative interpretations. They are categories consistently recognized in depreciation and cost segregation guidance. The building itself, the structural shell, still follows the long depreciation schedule, but many components inside and around the building do not. Identifying these components correctly is where cost segregation comes in. A cost segregation study is a detailed engineering-based analysis that breaks the property's total cost into individual components and assigns each component the fastest allowable depreciation schedule. So instead of treating everything as a 27.5-year or 39-year property, a properly prepared study might reclassify 25% to 40% of the building's cost into 5, 7, or a 15-year property. When those shorter life assets qualify for 100% bonus depreciation, the deduction can be taken immediately. This is not aggressive tax planning. This is well-established strategy that has been used by institutional investors for decades and is now more accessible to small and mid-sized investors. Let's walk through a realistic Inland Empire example. Imagine you purchase an 8-unit multifamily property in Upland in early 2026 for, let's just say, $850,000. A reasonable allocation might look like this. The land, $200,000, the building, $650,000. Now, you place the property in service as a rental and order a cost segregation study in the same tax year. The study identifies approximately $185,000 of building costs as a shorter life property, including interior finishes and cabinetry, HVAC and mechanical components, lighting and certain electrical systems, parking lot, and exterior improvements. Now, under permanent 100% bonus depreciation, you may be able to deduct the entire $185,000 in 1 year, subject to your specific tax situation. At a 24% federal marginal tax rate, that equates to approximately $185,000 times 24% equals $44,000 in federal tax savings in the first year. California's top marginal rate exceeds 9% for many investors, so combined federal and state savings could actually be higher, though exact results will depend on your personal tax profile. This is not guaranteed savings. It's an illustrative example of how math works when these strategies are applied correctly. That $40,000 plus in reduced tax liability can be redirected toward your next down payment in Riverside or San Bernardino County, paying down higher interest debt, funding value-add renovations, or strengthening liquidity and reserves. Now, this is how tax strategy translates into real leverage. Here's the clean framework investors typically follow. Number 1, acquire the investment property. Number 2, place it in service as a rental or business property. Number 3, order the cost segregation study, ideally in the same tax year. 4, work with a real estate focused CPA to classify qualifying assets. 5, apply 100% bonus depreciation to those assets under current law. This benefit is not just tax reduction, it's timing. You're pulling deductions forward into the years when they're often the most valuable. Now, if you're getting value from this video, be sure to hit that subscribe button and turn on the notifications so that you don't miss videos like this. Now let's talk about Section 179D, an often overlooked but powerful deduction for commercial and certain multifamily properties. Section 179D allows a per square foot deduction for qualifying energy efficient improvements such as HVAC systems, interior and exterior lighting, building envelope improvements. Here's the critical detail. Under OBBBA, the subsequent IRS and industry guidance, projects must begin construction before June 30th, 2026 to qualify under the current Section 179D rules. This does not mean that the project must be completed by that date. It just means that construction must begin, breaking ground or starting qualifying work before June 20th, 2026. Now, if you're planning HVAC upgrades in Riverside's retail center, lighting retrofits in San Bernardino's industrial building, energy improvements in Fontana or Moreno Valley's multifamily asset, the clock is already ticking. This is a timing-sensitive deduction that requires coordination between your CPA, contractors, and sometimes an energy tax specialist. Even with bonus depreciation energy deductions, 1031 exchanges still remain one of the most powerful tools available. A 1031 exchange allows you to sell investment real property and reinvest the proceeds into other like-kind real property, deferring capital gains and depreciation recapture as long as you follow the rules. OBBBA did not repeal 1031 exchanges for real property. In 2026, investors are still using 1031 exchanges to trade out of underperforming assets, consolidate smaller properties into larger ones, repositioning portfolios without triggering immediate tax. Some advanced investors also combine 1031 exchanges with cost segregation on the replacement property, accelerating deductions after deferring gains, always with professional guidance. Qualified Opportunity Zones, often called QOZ or just OZ, investing remains in effect under current law with the core structure preserved. The key long-term benefits still exist. If you hold a qualifying investment in a qualified opportunity fund for at least 10 years, you may elect to exclude post-investment appreciation from capital gains tax, subject to meeting all the statutory requirements. This benefit applies to appreciation inside the fund, not necessarily the original deferred gain, and it is subject to current QOF rules, timing requirements, and elections. These are designated opportunity zones in parts of Riverside and San Bernardino counties, which can make certain development or repositioning projects attractive, but this is an area where a specialized tax and legal advice is essential. Market conditions matter too. As we move through 2026, inventory is higher than the tightest pandemic years. Price growth has moderated. Demand remains supported by population and employment trends. That creates a window where tax efficiency can drive returns just as much as appreciation. Now, one critical reminder, these strategies are powerful but complex, so you should always work with a CPA who specializes in real estate, a reputable cost segregation provider, tax attorneys, or QOZ specialists when appropriate. Your role is to understand the strategy, but their role is to implement and defend it. Now, here is your action checklist. Review bonus depreciation and cost segregation opportunities. Evaluate Section 179D projects before June 20th, 2026. Consider 1031 exchanges for appreciated assets. Explore opportunity zones only with proper guidance, and build a coordinated advisory team. And if this video has helped you, like it, share it, and send it to someone building real estate wealth in the Inland Empire. 2026 is not about guessing, it's about alignment between your deals, your tax strategy, and your team. Thanks again for watching.